The coffee can investing is a term that you made popular, essentially meaning long-term investing, buy good businesses, buy good management at the right price and hold in for a long periods of time. Now the businesses are dynamic, businesses do change, and these days the pace of change is far too strong, far too fast. How does the value investing and coffee can investing remain relevant in these times where things do change?
So I first came across this term, Sachin, in 2014. An American fund manager called Rob Kirby had written a paper in the early 80s. I discovered it in 2014, and he said, buy good companies, dozen and a half, and in the American context, put them in a coffee can, and फिर वो coffee का tin अपने bed के नीचे रख दो. एक ज़माने में that's how Americans used to say. So मेरे को लगा this will be relevant to India, and that's why in 2017, 2018, my colleagues and I published a book.
Hello everyone, welcome to Kotak Conversation, the platform where we talk to the sharpest minds on the street on the matters that can affect your business, your income, your wealth. Friends, I think the market has been very volatile for the last couple of quarters, and we thought it's the right time to talk about value investing. And I'm fortunate to have two of the sharpest minds on value investing today on the panel. It gives me a great pleasure to welcome Saurabh Mukherjea, is the founder and CIO of Marcellus Investment Managers, and Nilesh Shah, founder of Envision Capital. So welcome friends, and it's great to have you on the show.
Thank you very much.
Thank you, Sachin.
Saurabh, let me start with you. The coffee can investing is a term that you made popular, essentially meaning long-term investing, buy good businesses, buy good management at the right price and hold in for a long periods of time. Now the businesses are dynamic, businesses do change, and these days the pace of change is far too strong, far too fast. How does the value investing and coffee can investing remain relevant in these times where things do change?
So I first came across this term, Sachin, in 2014. An American fund manager called Rob Kirby had written a paper in the early 80s. I discovered it in 2014, and he said, buy good companies, dozen and a half, and in the American context, put them in a coffee can, and फिर वो coffee का tin अपने bed के नीचे रख दो. एक ज़माने में that's how Americans used to say. So मेरे को लगा this will be relevant to India, and that's why in 2017, 2018, my colleagues and I published a book. It's now been translated to Gujarati, Marathi, Hindi, English, and thankfully the book has become part of, I think, day-to-day life in India. Now, in a way, the investment which best exemplifies coffee can investing would be Kotak Bank itself, right? As I'm sure those watching will know, Kotak's been a bank now for 22 years, right? It's been through its ups and downs. But when the going gets tough, the tough get going, right? So we are having this conversation in the early days of 2025, and the going is pretty tough in India, right? Liquidity tight है system में, NPAs are going up. And that's when you can see a bank like Kotak coming into its own. So coffee can investing comes into its own. Buying good companies, sitting tight on them becomes evidently a good strategy when the going gets tough. When the economy is roaring, every small cap is shooting through the sky, हर रोज एक IPO हो रहा है, then it feels like यार coffee can investing क्या boring चीज है, let's buy some bank. We've been through that phase in India. 2022, 23, early part of 2024 was like that. But now as the going gets tough, this whole philosophy of buying great companies and sitting on them will become, I think, very evident in the years ahead. And that's why I think this strategy, sit tight on great companies over long periods of time, becomes a good strategy. Right? There will be years when this strategy looks like the dumbest idea on the planet. There will be years when this strategy underperforms. We ourselves underperformed heavily in 2022, 2023. But as the going gets tough, this fiscal, we are seeing Marcellus's products once again come through. And more generally, and I think it's not just us, across the financial ecosystem in India, I'm seeing the same story. Funds like ours, investors like us who focus on high quality companies are having a better time as the economy softens, as we get into a cyclical downturn.
It's a great start because I can see the bullishness or a kind of a bullishness within your voice, which is so much very important in these times. Nilesh, you are running an offshore fund successfully for a long time. Tell me how the foreign LPs are looking at India at this point of time. Of course, all of them were very bullish for the last 2-3 years. Now, typically, the confused signals are there, the slowing economy, high valuations, a lot of money going out in the last 3-4 months. How exactly is the foreign LP viewing the India market?
I think they continue to be very constructive. The bigger challenge, like what you rightly alluded to, is basically the valuations. I think before even they basically kind of evaluate India more constructively, for them right now back home, it's actually a wonderful time. The US economy is roaring. It's probably currently the strongest pillar or the strongest ocean in a global context. So the whole question is, do we need to step outside of the United States? That's pretty much like a starting point. Second is that globally, the rest of the emerging markets haven't done well. You look at all the other big markets, they've pretty much not gone anywhere over whatever time frame you want to look. Even over, say, in a post-COVID era or over the last 10 years, 20 years, a lot of the gains that they've had has just got wiped off.
India is the only EM which over 10 years has made money.
So that's the second thing. But do they still kind of look at India positively? The answer is yes. It's just the sheer size of the market, the size of the economy, the breadth of the market, the different kind of businesses that they can invest in. And most importantly of all, one is a kind of a secular growth. It's hard to see economies continuing to grow between 5 to 8%. That's India's growth rates. I think for us, pretty much 5% becomes like kind of a rock bottom. 8% has become pretty much like our ceiling. So even if you take the midpoint 6 to 7%, hard to kind of see that. Number one. Number two, I think corporate India over the years has done an exemplary job. When we think about, we only think about growth, but clearly in terms of return on equity, return on capital employed, clearly corporate India stands out versus most other markets. So I think these are some of the things that basically attracts them to India. The long-term potential, the size of the opportunity, and essentially the performance of corporate India as measured by capital efficiency. These are things which stand out for India. Currently, in their mind, it's more about their own home market and the valuations. We've started to correct over the last 3 to 4 months. There has been a correction in the market. My view is during the course of the rest of the year, my view is that their thoughts and their words will convert into action, which is to start to put more money into our market. Because they will clearly begin to see that in context of the long-term growth, the long-term capital efficiency, the valuations have become now way more reasonable than what they used to be.
Understood. Now you kind of partly answered the question that I was wanting to ask you. Now we saw in last 3-4 months or maybe more, the FPI selling and there is a strong inflows by the Indian investor, typically mutual funds. And it was a counterbalancing for a long period of time. You think in this year, as we talk typically of FY25 and a little bit beyond, whether the flow reversing or both adding up, whether the DIs will keep putting more and more money, how do you think that the offshore and onshore flows will behave in, let's say, next 12 to 18 months?
My view is the DI flow will continue. And that DI flow should be looked upon more from the lens of the retail investor, the individual investor who's starting to put small monies. It's not that in a historical context, these amounts look large, but individually, the money is not something which is disproportionately high compared to essentially incomes or disposable incomes or the money that they put into other asset classes. So I don't see that changing materially. So the whole SIP kind of wave should continue. I believe that's a long-term secular trend. And will become even more relevant as long as the alternative returns, which is, say, the returns on a bank fixed deposits, which are probably around 7% on a pre-tax basis. If that continues, then over the long term, Indian equities have delivered 10 to 12% returns. And on a post-tax basis, clearly the relative outperformance of equities versus fixed income is even higher. So I'm less worried about the SIP part of it. I probably think that will continue. It probably will get bigger. In fact, yesterday we saw that the regulator is thinking about the sachet SIP, which is the 250 rupees. That's like quite significant. And I clearly believe that this whole SIP thing has become pretty much like the UPI wave. That UPI it began slowly. And then there were situations which converted the whole UPI thing into a mammoth wave. That from a few people starting off and making digital payments, today we have about 400 million people who essentially are registered on the UPI, and 200 to 300 million of the 400 million are active on UPI. I believe SIP is going through that thing and will probably only accelerate. As far as foreign investors are concerned, I think it's more about valuations. So that's been one irritant. The second thing, Sachin, is that I'm not maybe 100% right on this, but this is the kind of feedback one gets. So if, say, you as an Indian invest into the US market, probably you don't have to pay any tax in the US, you have to pay tax in India. But in India, it's a bit different. That if you are a foreign investor, you have to pay tax in India, and then you obviously can get credit for the tax you pay back home. That is also an irritant, or it comes up at least for discussions. Okay, so I think if the valuations become attractive, which they seem to be on that path, we seem to be gliding towards that situation. Maybe sometime by the middle of this year, maybe towards the end of this year, I clearly see that trend reversing, where from net sellers they become net buyers. And on top of that, if there are further tweaks in terms of the tax side of it, then obviously that will be pretty much a blessing in disguise, or I'd probably say sone pe suhaga.
Okay, got it. Now that's encouraging. Let me come to you for something on everybody's mind, the top of the mind agenda in that sense. The Trump policies. I think the first day directives and what you expect in the days to come. How is going to affect the US economy, finally the biggest economy in the world? So whatever happens there affects everywhere else. So I'm saying how is going to affect US in particular, and therefore the impact on India directly, indirectly. How you look at next 4 years? What are you expecting?
So look, I think Trump will have an impact. The precise details, obviously, the months ahead will tell us, Sachin. But I think the impact on the Indian economy could be adverse, and we as investors are now trying to figure out how to make money from this in the American context. So I'll quickly summarize. So in India, like any other free market economy, we go through economic downturns. India's economic downturns come in two flavors. The less painful ones would be, say, 2016, right? 2014, 15, after Prime Minister Modi's election were good years, right? The economy revved up. But to 2016, we went through a downturn. But because the dollar wasn't strengthening at that point, the RBI did the needful, liquidity was injected. 2017, we had a roaring recovery. There was plenty of cash in the system, I remember, in 2017, right? So the less painful downturns are where the dollar is not misbehaving, and therefore the central bank can do the needful to reflate the economy. The more painful downturns are, we have 3-4 good years in India, inevitably downturn आएगा, वो तो किसी भी free market में आता है, but the painful downturns are when we go into a downturn, and unfortunately for us, the dollar starts strengthening for factors we simply cannot control, right? India cannot control the strengthening of the dollar, it's Trump doing it. But if the dollar strengthens in a downturn in India as it is now, it makes it very difficult for the RBI to reflate the economy, and that extends the downturn. So 2012-13 was a super painful downturn, right? We kept tightening policy, and absolutely blasted the economy into the ground. It took a lot of effort for the new government to then get us back on our feet. My fear for the Indian economy is if Trump does his tariff business and strengthens the dollar further, I think it creates serious challenges back home for us from a monetary policy context, right? Now, in that context, our job as investors is to say, let's diversify. So 2.5 years ago, I started doing that, both for myself, for my family, for my colleagues, and for our clients. We said that, look, the world's two best performing markets are the United States and India. The data is very clear. Over 20 years, we are the better performing market than America. Over 10 years, they are the better performing market. Over 1 year, they're better. But it's usually between us and them, right? World ka 60-65% wealth comes from these two markets. Baki kisi desh mein khas paisa banta nahi hai. The even better thing for all of us, right, is the correlation between India and America is very low. Right? For reasons I don't fully understand, we are the least correlated of the world's big markets. So investment 101 जो मेरे को college first year में सिखाया था, diversify across assets with low correlation but high returns. High returns to asset classes, low correlation, आधा कर दीजिए. So we started investing 2.5 years ago in America, Gift City. We opened a small office and we started doing it. And that's obviously made us a lot of money over the last 12 months. And we think entry of Trump will reflate mid-market America capital goods, manufacturing, logistics, transport. Not the Magnificent Seven, but down the batting order in America, $10-20 billion market cap stocks are a mid-market, and they're available at 1 times PEG, right? 17-18% earnings growth. You can buy at 17 to 20 times PE multiples. So you're getting high-class companies generating cash, and I think if Trump does impose tariffs on China, strengthens the dollar, I think it creates challenges for us here. But in the American context, it reflates the mid-market, and we are trying to capitalize on that. I think there's also another way to think about what we are going through in India, right? Ever since Raghuram Rajanji did AQR back in 2015, our banking system has focused on lending to the middle class. And it's pretty evident now in the RBI data that the middle class is over-leveraged, right? I think yesterday the HUL CEO made the point that because of the sheer amounts of debt in the urban middle class, urban consumption is under the pump. It becomes harder for the RBI to cut rates if the rupee is constantly under the pressure. So I think the middle class consumption piece continues. And in that regard, I think the government in Delhi, the authorities have to make a tough call. Can they give fiscal incentives to get liquidity into the banking system? Because as I'm sure you in Kotak Bank, you guys are also seeing it. The banking system is starved of deposits. You've got plenty of money in the stock market. In a poor country, if the banking system is starved of deposits, obviously lending is grinding to 9-10%, which is hardly any lending growth. So government ko tough call lena padega. How do we give relief to the middle class? How do we give incentives to people to do deposits in the banking system? Stock market बढ़िया चला है, great stuff, बहुत पैसा आया है. But at this stage of development, if we suck our banks dry of liquidity, which is what's happening, it will have long-term ramifications for the SME sector and for the country's developments. And in parallel, and it's a related issue, middle class is over-indebted, which is why banks they don't have surplus liquidity and they have put money in the stock market. It's a very strange situation, and I think it requires a policy response from New Delhi. Hopefully the budget will contain some responses on this subject. So I think we're heading into a cyclical downturn. Nothing wrong in that. Har ek economy ka hota hai, but it's painful for us when the dollar strengthens. That's the piece that Trump is triggering. We as investors need to capitalize on that by seeing if we can load up further on America through our global portfolio. In the meantime, back home, we need to be circumspect about what's happening in literally in the city of Mumbai, Bangalore, Delhi, where the middle class seems to be overstretched.
Nilesh, you want to add anything? Because that's something which is actually is going to impact probably the US and India markets both. So is there something that you want to add to that?
So, Sachin, probably what's happening globally, especially in terms of, I mean, last year the world was essentially talking only about AI. This year the whole talk is about tariffs, and that tariffs itself is going to have, you'd probably say that it has probably a ripple effect globally. I think India will need a very strong response mechanism. And response mechanism in terms of saying is, how do you make Indian businesses even more competitive? See, if you look at some of the things, I mean, we've been always talking about, ease of doing business, but there's also cost of doing business, which means the cost coming in from your power cost or your interest rates, and also other things like, say, your GST rate. Now, if there is to be a fiscal response, we normally think about fiscal response as, direct taxes, saying, do you kind of increase tax exemption limit so that there's money in the hands of the middle income, which obviously might be required. But most importantly is to make manufacturing even more competitive. Because now your benchmark is not just China. Your benchmark will have to be the United States. So clearly you have one more perspective to look at, and what needs to be done to ensure that Indian manufacturing is competitive not just vis-a-vis our Asian peers, but we'll have to now look at it in context of the United States. And that response will have to be quite different. This is not just about labor arbitrage. This is about many other things. So it will require probably a completely fresh view. I think the government has tried its bit by lowering the income tax rate for manufacturing companies, and probably our income tax rate for manufacturing companies are probably the lowest in Asia. I think sub 20%, what was the rate? I probably think there was a sunset clause to it, but I think if that can be extended or probably made permanent, I think that would be a great thing to have. But more importantly is maybe the whole GST apparatus in terms of the tax rates, the number of taxes that we have. If all that can essentially also be looked at, and that's something which probably may not just be, it can be addressed in the budget itself, but will have to require a much broader discussions with the states also. I think those are some of the things that will have to be done. So I think so far the onus has fallen only upon the union government, the federal government or the central government. It will now, I think the onus also shifts to the states. That how do they encourage even more and more manufacturing, make it more competitive. GST is an important way to do it. But in addition to all of that, and also the government spending which has got restrained or has not been at the pace at which it was probably expected to be, no matter what, it definitely has implications on fiscal deficit, but it will have to be upped, because that's the only way we can also make manufacturing competitive, because it's widely accepted that cost of logistics, cost of transportation is still way high. I think those numbers are that the logistics cost as a percentage of GDP is 13-14%. And that the target is to bring it down into single digits. Now that's quite a journey. That whole 13-14% to 8-9%, 5% is quite a journey. To achieve that 5%, huge amount of investments will require. That will require both money, financial resources, and it will require execution capabilities. So the whole, yes, I clearly believe that yes, there are headwinds, there are challenges, but how do we convert these headwinds and challenges into an opportunity? And maybe this probably will compel us to even kind of move fast forward on the next round of reforms.
Got it. So essentially, both of you are saying that the challenging times may come, but we have to adapt to those and actually improve ourselves.
And we have done that in the past. It's not that we are facing this kind of a slowdown or the challenges for the first time. I think in the past, India has responded very well. I actually believe that our regulators have been, I'd pretty much say, prophetic, that maybe it's quite possible they saw what was coming. And the Reserve Bank of India decided to basically tighten up things. Obviously, when a regulator tightens up, it's called the regulatory mechanism has been tightened. But maybe the intent or the objective was that let me try and see that this whole lending which is happening on the unsecured side, the personal side, the retail side, to individuals, to the middle class, how do I restrain it? And that journey probably started maybe 4 quarters ago. We are seeing the impact of that now. Maybe the capital markets regulator, SEBI, probably saw the whole derivatives thing kind of becoming so huge. It's saying, let's kind of, bring in measures before it gets too late. And therefore, if I look at it, maybe the regulators have been prophetic enough to start this process in 24. Who knows, even say the government also, when it's tried to slow down the spending, the government spending on infrastructure and all of that, maybe they saw that next year or maybe, the future is more challenging than what it has been. Let's somehow calibrate ourselves.
This launches into something that I wanted to ask you anyways. I think this last few years have been the large caps in the stocks have been moving in a particular direction, and we have not seen this kind of a divergence on small cap and mid cap happening last 2-3 years. When the going gets tough, like Saurabh's point some time back, whether there will be a mean divergence to mean in this year, whether the small caps will behave differently and large caps, probably the money flow will again happen to the large cap stocks. That's what you foresee happening in FY 25-26?
So yes, I mean, mean reversions, corrections of divergences are, I think, part of the market process. And these are things which keep happening for a few months, maybe a few quarters, maybe for a year or so. But Sachin, over the last 20-25 years I have been in the market, ultimately what matters is basically your earnings growth and the capital efficiency. Beyond a point, it doesn't matter whether you are really a large cap investor or you are a mid cap investor, you are a small cap investor. And provided that you are a long-term investor. So if you're an investor for the next few days, next few weeks, next few months, some of these allocation calls do matter. But if you are a long-term investor and you are trying to out there identify businesses which essentially have the ability to kind of grow in double digits and sustain relatively superior return on equity, return on capital employed, I think over a period of time, the outcome is likely to be favorable. It just doesn't matter whether it's a large cap, mid cap, or a small cap. And what has also happened over the last few years is that a lot of the disadvantages which the small size companies had, that disadvantage pretty much kind of got blunted. The introduction of the GST pretty much created a level playing field. The advent of technology, the advent of the digital economy gave access to businesses to kind of reach out to millions of consumers versus having to create a pure physical distribution model. So if you had a good product, you have the ability to reach out. And it's also created ability for consumers, especially in tier 2, tier 3, tier 4 cities, to kind of get access to products. So these two things have been pretty defining in the last maybe 5 to 8 years. The introduction of the GST and the advent of the digital economy. That has pretty much kind of taken away some of the advantages which pure large companies with balance sheet size had. That you could say only they have the right to win. I think some of that right to win has also got transferred to small to mid-sized companies. Just that the small to mid-sized companies, the ask is always higher because they need to show basically proof that we are as efficient and we stand high on governance standards. So I think as long as mid and small cap companies can also deliver growth, deliver capital efficiency and maintain high levels of governance, beyond that, I don't think anything else matters.
Correct. Fair point. Sort of, let me ask you a more fundamental question, more basic question in that sense. On one side, the valuation techniques for the brick and mortar may not be the correct term, but basically the basic businesses, the paint, the textile, the chemicals, the way one values those companies and the new age companies like e-commerce or a fintech, I mean, is that obviously the parameters cannot be the similar because the kind of profitabilities, etc., may not happen in the e-com in the initial period. So how do you look at these two sets, and both have generated wealth in their own means? So how do you evaluate differently these two different sets of companies?
So let me answer your question first, and then I'll pose, I think, what I think is the hardest valuation question for all of us in India today. So it's not just e-commerce. So it's not just a Zomato. Even if you look at, say, a more seemingly conventional business like Dr. Lal Path Labs, right? Yeah, koi bhi diagnostics company, many of the retail formats that are coming up, they're actually pretty capital light, right? So a Path Lab le lo, ya what Trent is doing, it's pretty capital light because you're leasing a store. The only capital you're really deploying is the working capital. And typically a year in, when a store becomes cash positive, Trent transfers it to a franchisee. Right? The prevailing wisdom in India today is build capitalized businesses. Jisme physical capital is really not the headache of the listed entity. Other than the headquarters building and probably 5 laptops, koi physical laptop capital listed entity ka hoga nahi. Abhi to servers, we don't even have servers anymore. Everything is on cloud. So capitalism without capital has become the defining narrative of our era. Yahan pe physical capital is no longer the headache of most listed entities. And therefore, for investors like us, focusing on the growth in cash flows becomes the imperative. You don't so much focus on capex कौन कर रहा है. एक ज़माना था कंपनी ने capex announce कर दिया, भाई वाह, now this is the time to think about assessing whether the promoter is doing the right capex or wrong capex. That sort of mental model of capex announcements are, there's still companies who work in the old economy, steel and cement, and they announce capex, but by definition, those sorts of capital intensive companies, 13, 14, 15% ROC के आगे जाना उनके लिए मुश्किल है. Whereas the companies who are focusing on capitalism without capital, where your main asset is intellectual property, processes, brand, an ability to attract customers, customer relationship management, that's where the high ROC, high cash generative businesses are. And our job as investors is to figure out growth kitna aayega. ठीक है? The underlying valuation paradigm, therefore, to my mind, is easy. The tough part is discount rate kya le? Because we've had a surplus of capital in India in the post-COVID, right? COVID ke dauran 2020, the Federal Reserve printed $10 trillion. they spread money around the world, right? So a lot of that money came to us both through the venture capital, private equity route, and through the stock market route. And now the capital cycle is normalizing, it's tightening, right? Both the American 10-year bond yield is going up, money is tightening. In India, in the banking system, we're seeing another layer of tightening. As cost of capital goes up, right, should people like us, should investors jack up discount rates? Because if you jack up discount rates, then companies with cash flows which are further out into the future will get valued less, right? Remember, the lower the discount rate, the more the market will value companies with long dated cash flows, right? So will discount rates now go up structurally for a few years, courtesy whatever is happening in China versus America, Trump, and so on and so forth? Or are we still in the age of very low discount rates, very low cost of capital, and hence the market is saying, "Chalo boss, let's look for companies that will generate a ton of cash flow, I'd say 10 years out," right? That's the part that I think is less clear to me. And my fear is on that reversion to mean point you raised, right? My fear is cost of capital now reverts to a mean, which is much higher than what we've seen in the 2020, 21, 22, 23, 24. COVID का जो cash था, Federal Reserve का 10 trillion printing, that was still pumping all of us up. शायद maybe that era of very low cost of capital now goes away, and hence all of us perhaps need to use a higher discount rate to discount cash flows of.
So let me change track. We are clearly in front of our eyes last 5 to 10 years. Like they always say, savers economy to investors economy. I think pretty evident in the SIP culture that has been really coming in. Now, your latest book looks at the how India is investing, right? Possibly it is useful for the viewers. Couple of trends maybe you want to talk about how India is investing in terms of geographies. Are there any preferences to the asset classes? What are the findings?
So I think there's three big findings in Behold the Leviathan, the unusual rise of modern India. So we published it in October. Thankfully, those who are listening seem to have bought tens of thousands of copies. So the message seems to have got out. Three big messages. The first is the rise of women, right? So remarkable job done by state and central governments over the last 20 years. At school, college, university, every level, there are more girls studying than boys. Latest data, do din pehle aaya, it reinforces the point. More girls studying than boys at every level of the education system. The pass rates for women are much higher than the pass rates for boys. RBI data now shows that in urban areas, women have clearly more money in the bank than men. By the way, a lot of people tell me, "Arey, ye to tax ki wajah se hai." That's not true, right? This trend wasn't evident till 5 years ago. It's in the last 5 years, women's bank account savings have burgeoned. And some of the mutual funds have also done research which shows that in urban areas, women have more assets under management than their male counterparts, right? In parallel, right, so education women are surging ahead, savings and investing women are surging ahead. In parallel, RBI has published data, and most of the banks publish data, that women SME owners, default rates are half of male SME owners, right? And increasingly, from what we are seeing, and this last bit is anecdotal, Sachin, I think women are getting the best jobs, right? The job situation is pretty tight in India, but women are getting the best jobs. So ये बड़ा story है. I think this continues, right? As Nilesh mentioned, the rise of digital media, the light of the digital economy, India stack has had a big impact. I think one massive impact is utterly liberated women to go and build businesses, earn a lot of money. Dusra has the rise of a new economic elite. So a decade ago, as per government's income tax data, we had only 30,000 people reporting income of 1 crore or more. That number is now nearly 7x, 220,000 ke aaspas, right? This is a new elite, and increasingly this elite is not people like us, right, doing white collar jobs and speaking in English. This elite are people running a multitude of chota businesses in small town India. So they could be running a Maruti dealership, a cold storage, the school in that small town. They could also be a corporator in that small town and be a real estate baron in the small town, right? So the rise of a new elite, people are not fussed about speaking English, drinking gin and tonic, being members of posh clubs. People who speak the vernacular, but who have figured out how to do business in modern India is a massive story. So cities like Lucknow, Indore, Coimbatore, Kolhapur, these are booming. They're booming because a new elite has come through, and their savings are actually a big part of the savings that, say, your bank and my investment company is actually being driven by, right? And the third story is the rise of peninsular India. So the peninsular states account for a quarter of the population, half the GDP, and 2/3 of the GDP growth. So सारा देश का तड़पता धड़पता economy is peninsular India, right? If you add NCR and Gujarat to that, that's 80% of India's growth, which raises the concern, what exactly is happening in the rest of northern and eastern India. But peninsular India is the fastest growing region in the world, I think likely to remain so for the next decade. These three dimensions are actually very exciting for local investors, foreign investors, and I think they are the defining story of what I call the unusual rise of modern India.
Very useful, very useful. Nilesh, this particular couple of months in the start of the calendar year are very the allocation months, as we call it, on the foreign investors. Now, we have a very different kind of, and every year is different in that sense. As the foreign investor sits down today, talk about investing in US, of course, and the emerging markets. India expensive, China is at the 10 times, etc. All those factors are there. As a foreign investor in their mind, what is the kind of allocations that you think are happening, also to emerging and to India? Your guess on that?
So I think the allocation to emerging markets, I probably think, is very little. Most of them still are anchored to China because they have made huge investments in the past, and a lot of those investments are probably underwater for them. So it's more about averaging on the way down. So it's probably, I would say, more a compulsion to allocate. Also, that allocation has been disproportionately high because China moved out from being just an EM allocation or a regional allocation to being a country-specific allocation. Yeah, so that's what happened with China. And unfortunately, so they need to keep, probably they're still thinking whether they should be adding more and more to China. So clearly, China is there, but I would probably still think it's more out of compulsion. The other thing still continues to be India. The focus continues to be on India. And I think it's a sizable amount. I mean, yesterday I think there was an interview of the Norges Bank CEO, CIO, and they manage some 1.6 or 1.8 trillion dollars. So they have about 1.8% of all equities globally are owned by them. And of that, India still is not even $100 billion. Right? It's still a very small allocation. And they have liked the way India has delivered, corporate India has delivered, the kind of governance which a lot of companies have exhibited. I think they like India for growth, capital efficiency, and also this whole qualitative aspect of governance. Yes, there have been some black sheep here and there, but that does not represent, that's not a sample of, the other hundreds of companies that we have. So my view is that it is India. Undoubtedly, I think India is top out there in terms of the attention, the mind share. Now that mind share has to convert to money share. And my view is that it's quite possible that if we continue to see this volatility and this turbulence in 2025, my view is that probably this is the year where a lot of that mind share could convert into money share.
That's encouraging. One question I want to ask both of you. Budget is impending, but not necessarily budget. I think what you will like to see, one thing, let's say, one thing that India should do to again become a thriving economy, again becomes an investor's darling. One thing that you're looking forward to happening, and something that pitfall that one wants to avoid.
So I would still think, budget is the most important part of the budget is the whole tax regime. Yeah. So I think clearly the pitfall to avoid clearly should be that no more tinkering or tweaking. We've gone on long-term capital gains. We've gone from 0 to 10 and 10 to 12.5, and that 12.5 is effectively almost about 13.5 to 14%. I think, yes, last year it was justified on the grounds that we need to bring uniformity across asset classes. That objective has been achieved. So when you ask me what should be avoided, clearly now I think, especially in this environment, that's probably the last thing which should be resorted to. In terms of what I would want is clearly it may not be the best of platform on the occasion, but I clearly think it's a rethink on the entire GST regime. Clearly believe that from a GST perspective, we continue to be a highly taxed nation, because when it comes to taxes, we only look at the taxpayers on the income tax side, but we don't talk so much in terms of the whole GST thing. But clearly, do we need 4 or 5 different tax rates? Do we need tax rates which are as high as 12, 18 or 28, or we need to calibrate on that front? I clearly believe that there should be a think through on that. Also, a lot of items have been excluded from the GST, and that probably needs to be integrated so that truly the GST becomes one nation, one tax. So I would probably want to look forward to that.
Simplification of
yes,
GSTs.
though it's not entirely within the powers of the union government, but at least
No,
very
it's the
clear
policymakers, overall policymakers.
Yes.
Yeah, that's what. Saurabh?
So we are by and large a free market economy, so I think the economic downturn will take its course. I don't think the government should try to intervene too much. But in highly regulated sectors where regulators can have a massive bearing on the fate of the sector, we've seen the government is powerful in those sectors. And obviously, the heart of any economy is the banking system. I'm really worried about the banking system. I'm really worried about what's happening on the liability side. And I think we need to see the budget doing something for the banks to make it more worthwhile for people to keep money in bank deposits. We're too early in an economic evolution to say banks में पैसा नहीं होगा, casa में पैसा नहीं होगा, but somehow economic development आएगा. I think we need to get the SA piece going. Ka and Sa are not equal. A lot of people in the stock market confuse this. They say, "Arey, mutual fund में डालो, stock market में डालो." The money is in the system, but that's not true. Money in SA in any bank allows the bank, and I'm sure you know this better than I know, money in SA in any bank allows the bank to do a lot more for the country than money in KA, right? And by swinging money from bank SA of the public into the stock market, I think we're creating serious challenges for economic development. And I hope the budget gives fiscal incentives to depositors to juice up SA for the banking system. If there's one thing that could help the economy come out of this downturn quicker, I think there'll be incentives to juice up SA.
So as we come towards the closure of this today's conversations, I think let me ask you a little bit of a personal question. So Nilesh, you have been a colleague at Kotak for long years, your initial years. You want to share a memory of your Kotak memory of the earlier times?
No, I think there are many memories, but I think the landmark event, so like in the 90s, obviously, of course, when most of us didn't even know the names of international investment banks, and to see, Goldman Sachs, somebody called Goldman Sachs come and do a tie-up with Kotak, and we didn't even know what was Goldman Sachs. And the internet wasn't there, so what was Goldman Sachs, And then later on to kind of go and figure out that it's the world's biggest investment bank. And mind you, that time Kotak was not the biggest investment bank.
Correct.
And Kotak had probably just gone into investment banking. And here suddenly you realize, first it took us a lot of days to figure out what is Goldman Sachs. And then to basically find out the world's biggest investment bank, and like crazy numbers were coming up out there, that what is the size of Goldman Sachs. That coming and doing a joint venture, and then to get to know later that that's the only joint venture Goldman Sachs had anywhere on this planet was like crazy. I mean, today it probably sounds trivial. What's the big deal? We keep hearing about all these M&A transactions and all that, but people like us at that point of time didn't even know. We thought a public issue manager. We didn't even, हमको ये भी नहीं पता investment banker क्या होता है. Okay, मतलब neither investor है, neither banker है. मतलब what is investment banker? Okay, and then to see that, okay, now it is Goldman Sachs. So I think that has always stayed on. The second was when Kotak Bank opened its own branch, the first branch. And I started in Kotak here at Mittal Court. And then to essentially, and we obviously moved to Bhaktawar, but to see the place where you were sitting at becoming essentially the first branch, and I think it was the RBI governor then, Dr. Bimal Jalan, coming and inaugurating it in the evening. It was like a finance company bank ban gaya hai. And the place where you were sitting is now going to be the first branch. I think that were the two of my fondest memories overall. I mean, personally, individually, so there have been, a lot of good times, a lot of fond memories. And lastly of all, I think what defines Kotak is the culture. And when you are at Kotak, you don't realize it. It's only when you step out of Kotak, is when you realize that what's really kind of worked big time for Kotak, I think, is that culture. And that's something which is not easy to replicate. And the culture coming in from, the entire leadership team, and honestly, have always felt very fortunate to work with the kind of leadership team which Kotak had at that point of time. I mean, it's not just one or two people. I mean, it's like 5, 10, 15, 20 of them with whom you worked for 10, 15 long years. I think it's something which is hard to get.
Lovely stories. Lovely stories.
Saurabh, a cushy job in UK. You believed in India's story, came back, started enterprise of your own, and it's such a successful enterprise now. Your learnings, your advice to the young entrepreneurs watching this.
So I became an entrepreneur actually in the UK. So I quit my job in management consulting when I was 27. And I set up a firm in London to do investment advisory in the British stock market. When my wife and I turned 30 and we became parents, that's when we did some thinking about our future. It also helped that I believed that the UK financial system was going to crash. This was early 2007. I broadly figured out Lehman Brothers. We wrote, didn't write a book, but I wrote a 50-pager on how the financial system would blow up. This was in February 2007. My wife read it. She said, "Arey, tu to bol raha hai, fat jayega." And I said, "हाँ, वैसा तो होने वाला है, फटने वाला है." She said, "Why are we raising a family here?" I said, "This is a good point, yeah." I mean, so we sold that business early months of 08 and we migrated in 08, believing in the country. But we came here because we felt that we wanted to raise the kids here. We wanted to raise a family here. We believed it would be good for the children to go up here. But the big learning from me throughout all of this is, दूसरे लोग क्या बोलते हैं ज़्यादा time नहीं spend करने का सोचने में, right? Even then, not just in 2008. Even today, people say, West में जाओ, West में रहो, London में रहो, New York में रहो. I don't think there's any better place for a young professional to build a career than India. We just heard Nilesh's career, and I envy you guys for what you've seen at Kotak. I envy you guys for the years you spent seeing India develop when I wasn't here. And if you're watching and you're a young professional and you want to rise in the world, get educated. By all means, get educated in various other countries. There are fine universities in all parts of the world, but build your career in India. This will be the most exciting place to build a career over the next 20, 30 years.
Thank you so much. That comes to the close of this conversation. I mean, I'm having a great time actually and want this to continue. But thanks so much.
Thank
Always
you.
wonderful talking to you guys. Thanks so much.
Thanks.
Thank you.
That takes us to the end of today's Kotak conversation. Hope you enjoyed it as much as I did. Wait for the next one. Thanks for tuning in. Thank you so much.